2022. With the Federal Reserve 75 basis point rate hike last week, the probability of recession has doubled and the stocks are under increasing pressure. How should investors prepare for what may come next? The Federal Reserve raised interest rates last week by 75 basis points, the biggest single increase since 1994, and signaled more big hikes to come in its continued effort to tame the highest inflation the US has seen in 42 years. But the Fed may have created more questions than answers, especially since it said previously that a rate hike of that size was off the table. While markets initially cheered the Fed's announcement, recession risks are actually rising and market valuations are under more pressure. The likelihood of a recession on most econometric models has now risen from 30% to about 60%. The Fed suggested there could be continued acceleration in policy tightening, raising forecasts that the Fed funds rate could rise to over 3% by year's end and top out at 3.8%, well ahead of most economists and the Fed's own previous forecast. Well, aggressive positioning to slow the economy means greater risk of actually tipping it into the recession. Well, stocks now face further downside risk. It's notable that even as consumers' inflation expectations have risen significantly, the market's gauge of inflation expectations, known as break-even rates, appears rather stable. This means that the rise in the nominal interest rates, inflation premiums plus inflation-adjusted real rates has been accounted to almost entirely by real rates. That's concerning because soaring real rates could continue to pressure equity valuation multiples just as earnings forecasts are being reduced by recession fears. Now, further complicating the efforts in emerging evidence that inflation may be peaking and economy cooling on its own. Yes, inflation is still high and May's consumer price index level was disappointing. But recent producer price index data were better than expected on almost every score. In addition, price gains for goods are starting to decelerate as supply chains clear, inventories rebuild and demand cools, as evidenced by weaker retail sales. Housing-related demand is also slowing, and perhaps most compelling, the Atlanta Fed is currently forecasting 0% quarter-over-quarter GDP growth for the second quarter. Now, this all raises the question, is a true economic soft landing still possible? Is there going to be economic crisis soon? We think so, but worry, the possibility may now be slim. Inflation this cycle seems to be driven by things that the Fed can't control, such as geopolitics. What's more, the Fed's efforts to tighten financial conditions through rate hikes and balance sheet reduction may not be the cure needed for today's inflation, given that it was extreme levels of fiscal stimulus providing liquidity to households and markets, not excessive borrowing, that likely drove excess demand in the first place. Well, as we continue to weigh bull and bear case scenarios for the economy and markets, investors should watch financial conditions in the US and beyond as global central banks also begin tightening their monetary policies. Portfolio strategies to consider now include maximum diversification, quality factors, and active management. Deploy fresh cash towards investment grade bonds, international stock funds, and select cyclical areas. Now, here we are focused on small and mid cap stocks, especially in biotech, financials, energy, and industrials. After a 2-year hiatus due to the COVID-19 pandemic, the world's top leaders met at the Swiss mountain village of Davos this week to tackle global issues and find solutions to the world's most immediate challenges. Well, economists fear that the recession could occur in 2023, particularly if the Fed's interest rates stifle demand from individuals and businesses or if its inflation strategy fails. Well, this was all about it. Stay with us. We shall bring you more such interesting topics to talk on. This is Aparna Sundar reporting for iScope Media.